Buying stocks in 2025 won't be an easy year. Still, there are opportunities, and in this video, I present them to you. 10 great potential high opportunity companies, not just for the short term, but also for the long term. Many opportunities succeed in generating returns, allowing us to become financially free. These 10 stocks come from different sectors and are all aimed at significant potential growth. That means there is also a higher risk profile associated with it, often because of a bit more uncertainty in those companies. In Mars, if everything is known about the company, then the price has already been factored in, and you will never be able to achieve exponential returns, and certainly not in the short term. Now, in this analysis, for this top 10, 7 or 8 of them have been selected based on the algorithms we use. Proven algorithms, that's where we find the potential winners ourselves. I also have a number of those in my own portfolio, which I of course share with you frequently. Actually, I share my portfolio very openly and honestly almost every month. So that's why. Can you keep following us for more tips? Before we move on, these top 10 stocks for 2025, a small request from my side. Every percent of you isn't subscribed to our channel. My question is, if you have ever found value in our videos that have helped you at some point, would you then do us a small favor and subscribe to our channel? Why? Not only will you receive tips in the future to help grow your wealth and simple investing for financial freedom, but also the bigger we get as a channel, the more time and energy we can invest to create higher video quality, but also to invest in more databases and tools to increase our chances of success. I've been experiencing it myself for over 10 years. I have now become financially free thanks to investing in stocks. That's all my expertise. Entrepreneurship, companies, also with a university background in. So I realize, especially with stocks, but it remains a bit difficult to find good stocks, and especially go at the right moment to buy. So valuation is an important part, and these 10 stocks, yes, some of them will not perform well. I am convinced of that, but perhaps there is one, or maybe even two. If we do really well, we will achieve some really good growth by 2025. Also, let me know what you think about it. Of these stocks, do you have more insider knowledge? Share it, add value to the world, then we can help each other a bit. But also let me know if you think, well, this is quite risky. Point it out to people, and then maybe by yourself to learn what the risks are. Let's now take a look at the top 10
Could
stocks.
one of the best stocks for 2025 be and remain Evolution? At least that's my forecast. Below we see Evolution, which is definitely one of my largest positions at the moment, and it's down 15%. I started buying in the summer of 2024 and recently bought more because the stock is it's dropped. Now, this is a strong mode company, meaning a company with a competitive advantage. In a nutshell, what they do is, for the casinos, they basically have online casinos, custom made, bobbins, and the strongest thing they are skilled in is live casino. Here they have carved out a niche to a strong cognitive advantage. They have quite a few other games, as you can see on Evolution's own website, but what is also more interesting is the kind of mini acquisition strategy that they are doing, a kind of dividend policy that they use, and especially the management with higher inside ownership, and the share has recently fallen a lot. This is based on several reasons, actually, and even today, while recording this video, it has also gone down by about 2% due to the CFO leaving, which is not good news for us. So it's really a perfect storm for this company. The rating from Morningstar is 111.44 SEC, I should say. I personally buy it in euros. The company is currently not listed on the UC, but it is in Europe. The price out of the list is around 100,000, up to 300,000. Now, when I look at the forecasting, I've already done several analyses on Evolution. Check out our website for that. I also share my portfolio frequently. So you can also see our portfolio update for the complete Evolution update. But at the moment, the PE has once again dropped to 13.5. And actually with a modest forecast in terms of EPS growth, that doesn't have a high chance for this stock. Would a PE of 15 be equal? You get an average return of 15%, including dividends. I believe that a PE of 20 is more realistic for this good company. And then a higher average return could be realistic. So the PE has dropped to 13, which is actually very cheap. What's more important is the current valuation rather than the future growth. For that, we look at the pain ratio. Look it up if you don't know what the pain ratio means. That's below 1, and that's a positive thing. And it doesn't happen very often for a strong company like Evolution. what is also simply referred to as a high quality compounder. The price to cash flow is also particularly low. If you ask me, the dividend yield has only increased, although I personally wouldn't buy just for the dividend, but really just the growth. The market cap has dropped to actually a relatively small company. Meanwhile, total debt is very low, and they have a little bit of cash. The growth is attractive, and in particular, very interesting for long-term investors, of course. What is the performance of, for example, the return on equity and the return on total capital? And you can also see that the 5-year average is particularly high. So evolution is very interesting. And due to a combination of circumstances, it has actually dropped a lot to a level that is actually recently at the price level of 2022 and 2020. I think this reaction here is exaggerated. Yes. And if you really dive into the company and also look at our multiple analyses on evolution, then do you perhaps agree with me? But will it be the best performing stock for the coming year? I don't know. Definitely. That also has to do with momentum. In any case, I think evolution is currently undervalued. It doesn't happen very often for a high quality compounder. And I think that's why it has shifted for me in my portfolio to grow it into one of the larger positions. And I actually expect at least a 10% return for the coming years, with the intention of at least seeing it over the next 3 to 5 years, how this company develops further. PayPal might be one of the best stocks to buy in 2025. And in this short analysis, I will show you why PayPal is doing reasonably well. Of course, everyone knows the company, and for a long time, there has been a lot of uncertainty surrounding the stock. Recently, it has risen to about $88 per share. Morningstar's fair value estimate is 104 with a 4-star rating. And if we look at a bit of forecasting, the current price to earnings ratio has actually risen from, say, which is quite low for a strong war brand like PayPal. Looking at a price to earnings of 19. Now, the norm multiple is 31, and the EPS estimates below. So the earnings per share, analysts' estimates are not very exaggerated, high, about 10% per year, and seems realistic. But a multiple of 30 seems a bit on the high side. Now, let's say this forecast is correct, which is never the case. But let's say it moves in line around these averages, and the price of earnings comes out to T2, for example, which is neither on the high side nor on the low side. Then the annual return could be 15 to 16% from this moment on. So even though the stock has risen a bit, it could still be a good buying opportunity. When we look at the factor returns, it's currently a strong buy. That means this stock performs relatively well compared to 4,000 other stocks based on various statistics. Bye-bye. The valuation might be a bit higher in the short term, along with the price earnings of 2022. And the pain ratio for the next 5 years in relation to profit growth is below 1, and that's always positive. But it is indeed a bit higher than the sector median. That means that within the same sector, there might be better buys to be found. Although PayPal might enjoy higher quality due to their well-known reputation. And we must never forget that in our valuations, now the price to cash flow of 13 is relatively low. If you ask me, there's not much special regarding debts and cash position. The growth reason is also relatively positive for PayPal, and that will of course be decisive for 2025. Performance, if we look at the EBIT growth for the upcoming period, it doesn't seem very exciting, but the EPS growth in the long term is also around 10% in this database. So that seems plausible. And usually because so many analysts have looked into this, those forecasts seem to be quite accurate. Retail equity is currently at 20%, and that is positive and increased compared to the 5-year average. Now, those profit margins might not be very impressive and even lower than the second medium, but this is exactly the opportunity for PayPal, which is actually in a kind of turnaround with new management to make the company more profitable again. They also have a very interesting, fast-growing app, Venmo. Keep that in mind. It's interesting to know that at Motley Fool's, PayPal is ranked number 3 among analysts. Motley Fool's also has some kind of quant ranking. That's actually a bit the same as in terms of the rating that we see here, and in that PayPal even ranks number 1 as a strong buy. The Zex rank is a bit less positive. That indicates a hold rating. However, their price target is around $95. If we look at other analysts regarding price target, then that's around the same level. 95 still means about 10 to 15% upside potential for PayPal. In any case, if you can believe these price targets, I don't know if that's the case, but looking at the long term is much easier. And I think that PayPal, even with a price to earnings ratio of 20, which isn't super cheap, is that so? it has the potential to increase in value for at least the coming years in the long term. Why? Also because profitability can be significantly improved, and the new management has the task of doing that. Now, for a long time, it has been influenced by the results. Actually, since the last buying moment, it has risen by about 35%. We share these buying and selling moments on our website. For that, look at ETFs and stock tips on happyinvestors.nl or businessinvestors.nl. Now you see that PayPal has dropped a lot by about 70%. However, 2022-2021 was, of course, a year of strong overextension, and the current price level is around 2018. Of course, PayPal has grown a bit in terms of its network during that time, but not by a lot. So it's justified that there was a significant drop, but the latest increase suggests that more is to come. Definitely, especially when we look at other factors and statistics, and of course, the most important fundamental developments. Does PayPal definitely have opportunities for 2025, but also for that long term? Zeta Holdings is a fantastic growth stock for 2025, but definitely also for the long term with great management and asset light business model and interesting opportunities, especially because they have a strategic acquisition strategy. Now, Zeta Holdings has recently dropped by 50%. This seems to me like an interesting buying opportunity for 2025, but the ride will be very volatile, especially if growth is less than expected. Now, regarding Zeta Holdings, a short report has recently come out with a number of claims. I didn't find it very strong myself, but the stock did drop by more than 50% because of that. The management has made a statement, as you can see here. For that, go to the investors, zetaglobal.com. What I find interesting to show is the board of directors. There are a number of very well-known names in there, such as John Scully, also worked at Apple. The CEO, and is me, David Steinberg. I think he's an experienced man. Not all his businesses have performed well in the past. He has had some misses, but yes, that also makes you a better entrepreneur. Furthermore, you see that a number of interesting positions are being filled by experienced men who have also been with Zeta for a long time. So Steven since 2009, then we see the CEO, TO. He has been called Christian since 2017, the Chief Data Officer since 2017, and there are a few more people who have been with the company relatively early. Also the CFO since 2020, so a fairly experienced team. Yes, major powers, and I all think it's very strategically strong. The downside of Zeta, of course, is that it's a marketing platform. They even position it as an all-in-one platform for marketing. They have done that very well with strategic acquisitions. They also won a number of important deals in the last quarter of 2024, and revenue keeps rising significantly, especially larger clients who continue to stay with Zeta, and that's of course very important for the means of transport. You can also see that the revenue growth is there. Interesting, especially for the recent period. And the target for 2025 is to grow to at least more than 1 billion. The current market value is around 4.5 billion. So the price to sales ratio will be around 4.5. That's not very cheap. Only Zeta can grow further and faster in the future. But because it's an online platform for marketing, especially technology, then you have technological disruption. It could very well be that the platform becomes less relevant compared to competitors for whatever reason, and that's always a risk. So the ride will be very volatile. Monix gives 2 stars. The fair value of SMT is $20. The current price is $18. If we look at a number of other analysts, they are more bullish. In total, there are 15, and they indicate a price target of 37. Looking at Fastcraft's, it's actually a tool to see the price correlated with the EPS growth, the earnings growth, to understand what the potential forecast could be. And this model is quite accurate. Well, I think with the slower growing stocks that have a very long history, so more than 20 years, for example, Nestle has recently dropped a lot and seems undervalued based on Fastcraft's data. But we're here for Zeta. This is a growth stock, and for that, the model is a bit less accurate. So we should take this with a grain of salt. Furthermore, we see the profit growth forecast below. And for some reason, analysts think that the profit in 2026 will actually be negative. Although it's just minus 1% and then a significant growth of 60%. I think that long-term profit growth is here from 2025 to 2027, that could be realistic. The current price to earnings ratio is estimated to be 30 for next year, so the forward to date price earnings. Now, let's say the price to earnings ratio is only 20 in a few years from now, and that growth is being realized, then you still have a positive return, but it could be much more, but also much less. And that is, of course, investing. This makes it very difficult to value Zeta. It's a growth stock. I've been investing in growth stocks for over 10 years, and I actually see a lot of interesting things with me, especially for the strong management, the acquisition strategy that works, and also just the platform asset light earning model, high profit margins and potential. It has a lot of interesting characteristics. Also, if you look at the market value, that's not very high. At the moment, the market value is 4.3 billion. Well, there is almost no debt. That's actually just not very much. And cash position has now been built up. They also bought back 100 million in shares following that short report. You can also find that here in Zeta's statement. So we bought back 100 million in shares somewhere around this price level. I actually don't think that's very much. Maybe they should have bought back more. Maybe management should buy back more themselves to show what the confidence is. On the other hand, they might be better off investing that money in several initiatives. We'll see, time will tell. I do have confidence in Zeta, so my position in Zeta Holdings is about 5%. However, I bought somewhere around here, so such great timing. I'll show you. Moreover, I frequently share my portfolio updates, so I would definitely appreciate it. If you take the little effort to subscribe and also like the video, that always helps us, the algorithm. And we see here in Zeta Holdings, my position has actually dropped quite a bit, down 28%, so that's not very good. But I'm not worried about it. I even bought a little more after that big drop. Unfortunately, I bought just before that drop, not exactly before it, but somewhere, before it had risen a bit further. So I was up 30% at first, and 2 months later, I suddenly found myself down 5%. But I bought just a tiny bit more. I'm not going to buy more because my position is about 4.55% of the total portfolio. And I think that's enough for a risky stock like Zeta. I probably should have bought a little less and applied more DCA, but that's always easy in hindsight. Judgments. The look ratio is very important. That indicates 0.8, so it seems like the PE is high. For example, also EV to sales or price to sales. It's not cheap. On the other hand, if you compare this to, for example, the Trade Desk or say Apple Loving, that one, I'll show you, which is currently up 36% for me. Yes, those valuations are all much higher than Zeta, while Zeta has at least the same growth potential. In any case, in the medium term of 2 to 3 years, looking very far into the future is really difficult, but thinking more short term is a bit easier. And then I think Zeta is really after this recent price drop. It can be attractive for long term investors, but again, the ride is going to be very volatile. And a small position, for example, invest 2%, at least it prevents the loss from being painful during big drops. EPS growth is estimated to be relatively high. The forward EPS growth for the next 3 to 5 years, 40% is estimated, so that's very high. At the moment, the factor analysis is a hold. Was it strong for a long time? Buy, but that's also because of and momentum and revisions have decreased a bit, and that happens often. If suddenly the stock drops, is the analyst going to lower the expectations? That's why it's actually more interesting to examine growth stocks on a fundamental level. Strong management, good earning model, interesting strategic initiatives. When the market hasn't really spotted the growth stock yet, that's the kind of stock we try to find the most. But Zeta no longer falls under that. Unfortunately, but we find enough of them from time to time, and we share those through the channel. So subscribing is greatly appreciated. Then you'll be the first to get these new updates. Look, the profitability isn't so positive at the moment, but it's really a good stock. So it's just now moving towards the curve to positive. So this can potentially rise very quickly. That also happened with Uploving. And if it goes the right way and they suddenly start making a lot of profit, then price will rise sharply. And once again, with a market value of 4.5 billion, can Zeta easily rise much faster? If they manage to retain their customers and grow the current customer base, then they're really doing well. And then also new customers supplementing, yes, then it's a promising company to invest in. The free cash flow is still positive at the moment, although its net income, so they are making a loss, only free cash flow is positive. You can also see that the capex investments are relatively very small. That means it's a light earning model. In other words, if you're building a factory and you want to build a second factory, then you're spending a lot of money but Zeta can easily make a number of software acquisitions that are relatively inexpensive, or even develop some programs themselves and implement that very quickly among all the customers they already have. And as a result, you have a very high return on investment on your initiatives or even strategic acquisitions that are naturally a bit more expensive. By the way, those don't fall under capex, but under acquisitions that you see below. Zexrank gives a hold rating, but they haven't researched the numbers properly. So there's nothing interesting to mention about that. You can see that recently the stock has risen a lot. In 2024, it was one of the better stocks with even a plus of 200%. Now, it's only at plus 60%. The short report came from somewhere around here, and then the stock actually just dropped by 50%. I bought some more here, and then it had risen for a while. Now it has dropped again to minus 40%, or actually even minus 47%. What we see is that there might be a support level here. If you believe in technical analysis, I don't do that much myself, but see it in the very short term. Still, technical analysis is a certain factor for the price. In the very short term, because there are simply a lot of players, those trade in the short term, and that can either push a stock further down or indicate that there's a support level. But the question is whether that's the case with Zeta. The Marconi is starting to become more negative, so I'm really curious to see how that goes for the rest. You can see that the stock has actually been listed since 2021, and I think you just have to believe in the management at Zeta and the initiatives they're taking. So, search very well. The fundamental matter of this company, what are they going to do? And will they make more profit in the future? What have they done in the past? And that looks demonstrably good when you look at the data they're showing here. The free cash flow target is, for example, plus $110 million for the coming year. If you believe in that, then I think the valuation isn't too high. It's just very difficult to assess, and everything depends on the longer term growth for, of course, 2026, 2027, 2028, and beyond. And I think if we can maintain that good trajectory with about 10 to 50% profit growth per year for the next 5 years, then this is a fairly good price to get in. But again, keep in mind significant price drops, and it's better to buy after a significant price drop than when it's at a very high peak and probably overvalued. Do you have questions about Zeta? Let me know. I would appreciate it. If you could give a like and subscribe if you find this video valuable. And we're moving on to the next analysis. The Allstate Corporation with the ticker symbol ALL is possibly one of the best stocks for 2025. In the short term, a period of 6 to 12 months. Now, full disclosure, I borrowed this number from Ed Alpha Picks because Staking Alpha is a program that actually picks out the best stocks, and they also have a demonstrable outperformance. They're doing really well, I have to say. And the wall discount link can be found in our YouTube description. So definitely check the description on YouTube. Click the link for the discount with more information about Alpha. You can try it for free for 7 or 14 days. Their thesis for the Allstate Corporation seems really interesting. They also indicate that a strategic turnaround plan has been implemented and taken place. As a result, the short-term profits have unexpectedly increased a lot, and this seems to keep going. They also have all sorts of other factors in their numbers. Great. Well, a very detailed analysis and a number of I will share interesting features of this stock with you. First of all, the current price has risen significantly to 119. Somehow, Morningstar indicates that the fair value estimate, according to them, is still around 140. That's why it gets 1 star. A big deviation from other analysts. Normally, about 20 analysts give a price down, 230. Most of the time, those analysts are pretty close for the short term, but definitely not for the long term. Morningstar looks more at the long term, of course, when it comes to intrinsic value. That's really for the long term. That 140 seems really low to me and doesn't add up. Are we looking at the price correlated with future earnings? And the estimates from analysts, which by the way also can't be right, but here it has definitely started to work. Allstate's tournament plan is working. Management is doing good business, makes more profit, and that profit could continue into 2025. Moreover, it's an insurance company. Insurance companies, you really have to be very poor at management not to be able to make a profit. But of course, it goes with cyclical movements. And a well-known example is Berkshire Hathaway. Now, the PI ratio from the past 5 years was only 10. So I've actually set it to 20 years now. And that seems realistic to me, 12 for an insurance company. And if we then take growth into account for the current valuation, then it could be above 10% annually for the coming years. And especially for 2025, it could very well outperform. But in the short term, is there maybe still a chance to wait for a better entry point? Now, factor analysis indicates a strong buy, actually one of the higher scores at the moment for Allstate. That's also why Seeking Alpha chose this stock on Alpha Pick. If you look at the valuation, it's just in line with the sector median. But for example, EV to sales has come down a bit, and price to sales is also relatively cheap. Price to cash flow is only, well, that's not very high. By the way, they pay out some dividends, namely 2%. The market cap is 50 billion. No specifics regarding cash and total debt. Growth seems interesting. Revenue is expected to creep up by 10% next year. EPS growth is already being estimated very high, so we should take that with a grain of salt. And if we look at profitability, it can really only go up from here. That's also the buy thesis. And so for 5 years, the profit margin was only 4% and has now risen to 6.7%. 2% doesn't seem like much, but for a company with 50 billion in market cap and a lot of sales, burger value, and with a lot of sales, because the price to sales is almost equal to 1, so then you also have 50 billion in revenue, then it's a 6% profit margin. If it rises to 7 or 8%, that's quite a significant increase. Return on equity has also increased remarkably for the upcoming period, and there it's 60%, as well as the return on capital. So apparently management is doing something very good here. So very interesting, still worth investigating further. 1 in the depth, 6 in the depth gives a hold rating. Hub price track is really still higher than the current price, namely also 222. And if we look at the whole bless you technical analysis, we see that the price has decreased percentage-wise at around 7%, so not very much. It could be that he finds some sort of support level around the price of a 191. It might drop a little further to level 175. That's this level right here. I don't think it will drop further because the valuation is already relatively cheap. There seem to be very positive developments regarding profit growth. So that means the company is going to become cheaper in the short term. And as a result, more investors will find this stock attractive. Also, for the very long term, as I already said, the business model of insurance is just interesting. And there could be significant declines. Cyclical declines, of course, with significant setbacks like natural disasters and all sorts of other issues. But look at the strategy of Allstate. Did you get it right? Be aware of the risks and invest a relatively small amount that you can afford to lose to, potentially keep your earnings limited.
Every now and then, you come across a fantastic small cap stock that could potentially go up tenfold or more in the very long term. And one of those companies is Candy Partners Group in terms of potential. We don't often find these kinds of interesting stocks, and in a short analysis of just a few minutes, I'll show you why Candy Partners could be very appealing for long-term investors who are willing to take a risk. Now, very interesting, if you go to the Candy Partners website, you'll find a number of crucial information sources, and very entertaining yet informative is the owner's manual. And the owner, Brad Kelly, has actually put together a textbook owner's manual. Not only will you find an overview of the company here, but what they do can be summed up in a nutshell. They acquire a lot of accounting firms. Here we see the revenue CAGR over 15 years. It's a serial acquirer, in other words, a kind of private equity-like firm that at the very least engages in buy and hold strategies for significant accounting firms. Right now they're still small, but as they continue to grow bigger and bigger, the acquisitions will also become larger and larger. It's a flywheel. There are a number of really interesting things in the owner's manual, and they are looking for example, quality shareholders. Yes, the explanation of the strategy, the business model is very interesting, but especially that these are also accounting people themselves, so they are very good with numbers. That also makes it very difficult to value this company. The official ticker is KPG, Candy Partners Group. The current market value in my own portfolio, well, not with DeGiro, but with Interactive Brokers, I have 2 accounts. Here's my market value, 8,000. We see that the total return at the moment is 26%. I only took a position last summer in 2024. Recent figures show that the revenue has grown again by about 30% year over year. It's going really well, but the stock is very difficult to value. I don't actually have the exact answer, to be honest. I bought here because I do believe in the management, even though it might look too good to be true. It might look too polished. Brett Kelly as CEO also literally looks sharp. Maybe a bit too sharp. Time will tell. I really believe in this company. It's one of my larger positions within my Interactive Brokers account. A few things, as we can see in the fundamentals, is, for example, Morningstar. It only gives 2 stars. The fair value is therefore $8 Australian. The current price is already a bit higher at the moment. That's also a very important point. 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 They have risen again. We can see that reflected in the prices. And for example, the earnings have increased significantly. The current price earnings is not 67, but that's 170. The price earnings of 67 indicates the future forward date next year. The price earnings of 67 indicates the future forward date or next year. But what's more interesting with serial acquirers is, of course, to look at the cash flow. Cash is king, that's everything. And that's why the company is really very difficult to value. For a long time, the price to cash flow was around 10. I took a position somewhere around the summer of 2024. Actually, my price to cash flow was 15, so not even superior. Now, the price has risen a lot, so the price to cash flow has also increased very quickly. For example, EBITDA has also increased rapidly. At first, there was a price to EBITDA of around 10, and now it's already 13, and still actually relatively low compared to a lot of other share world acquirers in the USA. But Kelly Partners Group is perhaps a bit riskier because it's just a smaller player and also not in the USA, so the valuation is therefore a bit lower. When it comes to forecasting, to be honest, there's not much to say, so we'll skip that quickly. A few key statistics. The price to earnings right now is around 170. It says 135 here, but that's not correct. It's 170. As a result, the price to cash flow is a bit higher on the higher side, and the price to book ratio is very high in this database. Now, it's very important to understand that it's a small cap. The current market value is not 300 million, but around 480 million, as it has recently increased a lot. And you can also see that the reliable databases we usually use for this stock aren't even that reliable. It just has to do with the fact that this ticker is not really known. The KPG is the original ticker. Here you also see a completely different ticker. It's just a small under the radar company, but very interesting. And what I find particularly interesting is the application of private equity. They're accountants, so they know very well how to handle the numbers, and they try to keep the profits as low as possible, which explains why the price to earnings ratio is so high at the moment. Nevertheless, the EBITDA margin is above 20%, and that's really good. And not only that, but they've been doing this for 5 years in a row while also achieving impressive growth, as we've seen. Return on equity is of course super important for private equity firms, but return on capital could be a bit higher as well. However, that should increase over time. Kelly Partners Group has risen significantly at the moment. Yes, the current price may have risen a bit too quickly based on the latest news. I took a position here at some point, but I don't remember exactly when. We saw the total return, which was 26%. So that was somewhere in the summer of 2024, and really with the intention to hold it for the very long term. So I've taken a relatively smaller position. It was around 3 or 4% in total, and the market value has currently also risen to 8,000, so that's about 3%. We'll see, time will tell. I think Kelly Partners Group is very interesting for the long term. Maybe not so much for the short term because of the recent rapid increase, but definitely for the long term. Now, do you want more of these kinds of ideas? Check out our website, go to the Happy Investors website, check out growth stocks. We offer analysis for growth stocks with monthly growth stocks that have potential exponential returns, but also a monthly update on top growth stocks or other packages that we offer. Are you international or do you prefer it in English? That works too. Then check out businessinvestors.info roughly later. We offer exactly the same services but in English because we are also active internationally. Thank you for watching. Let us know what you think of Kelly Partners Group. Definitely check out the owner's manual because it's super educational as an investor and it's worth investing your time in. A promising stock for 2025 is Lending Club with the ticker C. Now we have also reported on Upstart Holdings, which I have had in my portfolio for quite some time. Recently, however, I sold at the huge price peak of the last few months. However, Lending Club seems to have further potential for growth. Now, it's interesting to know that the stock has strong momentum. A number of price targets have been set. Now, the current price is around 17. The Morningstar fair value estimate is estimated at 16.3 stars. That is why analysts from Wall Street are giving a buy signal. They expect the price to rise a bit. Why would you want to invest in Lending Club? Well, I think especially in the short term, because it could benefit from strong growth in loans and due to the higher interest rates, but Lending Club has also secured a major deal with several banks, and that will definitely boost revenue and possibly profit significantly in the short term. There is quite a long history, and especially with the painful long decline, we look at the forecasting with the price to earnings ratio that seems high at first glance at 37. Could that maybe be okay? Why? Because the current EPS is so low that an EPS growth of, for example, 90% can be achieved quickly. And also for 2026, the estimates are relatively high. What could that mean? Let's assume that the price to earnings ratio is around 21 in 2 years, then you have a potential average return of 25% per year. So it's quite interesting, and there are a number of interesting characteristics about Lending Club that would make you want to investigate this company further. Note, investigate further. Now, one of the reliable tools we've been using for years is from Seeking Alpha with their quant data rating. Check the description of our YouTube channel and our YouTube videos for a special link with a big discount on this program, and also see other potentially interesting discount links for the tools we use. Now, why is the stock interesting? Because it scores high on valuation, growth, profitability, momentum, and revisions. And we particularly see from our experience with this tool that if the momentum is strong and revisions are an A+, and the valuation is still okay and growth is good, then you often see a stronger price increase, but it's not 100% science, of course. If you look at the current valuation, it seems a bit high. The PE ratio is not provided, but for non-GAPI it's 2, which isn't interesting. The price to earnings ratio of 830 is also a bit on the high side, but for example, the price to sales ratio is still relatively low. The EV to EBITDA is also not too high at all. And look, the company also has a relatively smaller market cap. It's still a small cap, just under 2 billion. It also has almost no debt. Well, a lot of cash. So yes, that's a very important factor to consider in your valuation when 50% of the market value is in cash. However, of course, it's a financial company, so you need to study the balance sheet and finances carefully. If we look at the growth rate, you might think, hey, B+, how can that be? Here you see all the less positive figures for next year. Well, it does have to do with the expected EPS growth, which is set to rise significantly in the coming period. Time will tell. Also, make sure to check those investor presentations and the annual reports carefully. Never buy without that information. The current margins are not that impressive at all, but this is where the opportunity might actually lie, because Lending Club has closed a number of big deals with banks, and Zexrank also thinks it's a strong buy precisely because of those deals and the strong momentum in lending, higher interest rates, which could lead to increased profitability. Yes, it might actually look better. By the way, the price stock from Zexrank is $19. It's slightly higher than the current price, but at the moment it's very strong. Within our stock alerts, we've been seeing LC coming for a while. We also reported at the last buy signal. We share a buy and sell report every week for more than 500 stocks. You'll find it on our website. Since the last buy signal, it has risen by about 100%. We wouldn't have bought at the first buy signal, but definitely at the third one, because we see that the underlying momentum has been getting stronger. And if you look at the long-term history, the price could still rise considerably compared to 2021. But 2021 was a period of significant overvaluation. So how far the price can actually rise, we don't know for sure, of course. If you maintain the price from 2017, the stock could almost double. If 2017 holds, then the stock could still almost double. So there seems to be potential for an increase from multiple perspectives. The momentum is very strong. Growth figures can be impressive, especially the EPS growth. So there might be something to gain here with Lending Club, but invest wisely and only in companies,
An interesting stock for 2025 is Carnival. Carnival is actually a growth stock. I wouldn't say it's a company with cruise ships. Why would it be a growth stock? Well, yes, because the profit growth is likely to be very interesting in the coming years. The upside potential is definitely there, but the ride will naturally be a bit more volatile. I personally have a position of about 3% in Carnival. It's in the Interactive Brokers portfolio. I also regularly share the DeGiro portfolio. So subscribe definitely to keep following those updates. Soon I will provide an update on my Interactive Brokers account. My total return is actually 0.2%. I bought somewhere around here in November, but recently it has dropped a little. A small dip. Could it drop a bit further? But valuation is still attractive. So I think the stock will continue to rise in any case for the upcoming period. If we look at some analysis, there are a few interesting things. First of all, the infinite ratings from quite a few analysts, they indicate that the price target is expected to be slightly higher than the current price, plus 20%. Let's take a look at Morningstar. They give a 4-star rating with a fair value that is actually around that same price target. So that implies potential high returns, at least for the short term. What will happen in the long term? No idea. We'll see about that. Let's look at the forecasting and devaluation based on the earnings growth per share. In other words, the EPS, the current or the own condition date price to earnings, has now dropped to 16.6 after a small dip. And if the growth expectations from analysts are correct, a total of about 22 and 11, and this looks quite realistic, then a price to earnings based on the normal multiple of the past 18 years of 16, which I think is realistic, could lead us to an average return of 18%. Of course, you have to take this with a grain of salt. That could be lower or higher. It's only interesting to look into the strategy after Carnival because, of course, they have been hit really hard by the corona crisis. And a big downside to this stock is that they have relatively high debts. So the market value is 31 billion and the amount of debt is 28 billion. Only management seems to have the position under control. And they have an interesting strategy to at least to boost a spending and attract more customers. That seems to be working really well because for several quarters in a row, they are achieving higher profits. Now the price to earnings, so that's now between 16 to 14 for the coming year. And the cash flow is actually very low, also a lot lower than the sector average. So that's important. And the price to sales is about 1.2. So it's a bit around that level. So if the market value is 31 billion and the price to sales is 1.2, then the revenue will be around 28 to 29 billion. And that could rise significantly. There are also a number of good initiatives that have been launched. So I'm really curious to see how they're going to perform. Yeah, I don't know. I have a holding in this myself, but it's only 3%. And yeah, if it doesn't work out, then 3% isn't that much of a loss, but it could potentially grow a lot. Do you also see that it has been heavily shorted on the factor analysis? This is already a data model that I trust a lot myself and has offered me a lot of success in the past. If you want to try this free, this program from Seeking Alpha, we have the discount link. You'll find it in the YouTube description. Definitely check out the discount link. You can also try it out for free for 14 days, and then you get the discount whether you want it or not. And a number of analyses that come out of this from Strong Buy, they often are potential winners for the coming year, and Carnival scores really high. As you can see, also with growth, a lot of interesting growth. So it's expected that the company will achieve much more growth and profit growth. That's why Carnival is a good stock. Mutual equity is currently remarkably high. And look, they come from minus 31% based on the 5-year average. But that is, of course, they were hit very hard by the coronavirus crisis. Mutual equity, at the moment, it's definitely very high. And the profit margin is starting to rise again. Zexrank gives a buy rating, always positive if they think that because they are more focused on the short term. The price target, which is expected to come in the next 6 to 12 months, is 27. We've seen other price targets. That's around 29. And the value estimate for Morningstar is around 31. Now, I do think that by 2025, Carnival could rise by about 20%, but we'll see. That will come with some volatility. You can also see that the price is starting to drop. So it's interesting to see how far, and those agreements occur frequently. Actually, it had already dropped by minus 76% here. So that's really bizarre. Recently, it had dropped again by minus 42%. So expect what the stock is going to do now is drop. If you're lucky and you're watching this video, then the price level drops to 19/20. That seems like an interesting moment to me. And don't forget the long history of the company. It has really dropped a lot, even down to a low of minus 90%. Then you think of a great company like Carnival, it's dropped so much, but that of course has to do with the coronavirus crisis. And yes, there is some uncertainty because of those high debts, but that actually presents the opportunity as management in which they succeed in just letting the company grow. If they can pay off those debts properly, then the profits can only increase more and faster because of course they will also pay less interest. So Carnival is not really a company that seems risky to invest in. Only in the financial situation it can actually be risky, but the upside potential can also be very interesting. Only in the financial situation can it actually be risky, but the upside potential can also be very interesting. Do you have more knowledge and insights about Carnival? Let me know, share your response, and help others with your insights. And I would too. I find it interesting to learn more about it, of course. I have a position of 3% myself, and I expect it for the short term, 25, 2026. And after that, I don't know. If the valuation has gone up too much, I think I will sell. Holdings is a relatively new company on the stock market with a market value of around 6 billion. That could be quite promising in the coming year. But this is a risky stock with a lot of volatility that experienced investors can benefit from, but beginner investors will likely have a lot of trouble with it. QT Holdings is a digital banking solution, and this is not the first finance stock in this edition for 2025. The interest rate is still relatively on the higher side. Higher side, not super high, but definitely on the higher side. And certain financial companies can just benefit from that. You also see on FI, for example, whether it's Landing Club or similar holdings, all relatively smaller, risky stocks that could potentially outperform, but they do carry a lot of risk. QT Holdings, the fair value assumption from Morningstar is definitely much lower than the current price, gives it 2 stars. Are we looking at analyst ratings? They really think that the price is a bit higher than the current one, but that means one, a potential return of just 3%. And I also think that Q10 Holdings has risen a bit too much based on recent results because they are doing very well and they will probably continue to do very well. Well, look, just that the price to earnings ratio is relatively on the higher side. It has risen very quickly in a short time. If you just look objectively at least 2025, 2026, and analysts are giving a high profit expectation of about 30 and 23%, well, that's definitely on the high side. Now, let's say the price to earnings ratio is, for example, 27, then there is still a potential loss of minus 16%. So the price to earnings ratio really needs to stay very high. Will there be positive returns? So actually, the price to earnings ratio needs to be around 40, and then you'll only have 2% returns. However, this is only based on the situation that this profit growth is being achieved. If that profit growth is lower than expected, will the share price drop? But if that profit growth is higher than expected, will the price still be able to rise significantly, at least in the short term? So that's really exciting. Well, and yes, you might wonder, why should I invest in the stock? If you look at, for example, the valuation, you can see that it all seems very expensive. Also, the EV to sales and the price to sales ratios are all really on the high side, certainly compared to the sector median. So this is anything but undervalued stock. This is really a good stock with possibly too high a price tag, but time will tell because you can only outperform beating the market if you do things that are different from expectations. Otherwise, you can never achieve high overall returns. I just think personally, I wouldn't go for QT Holdings. I don't have it in my portfolio either. So I'm not getting into it. It's too risky for me. But it could be that you have more expertise in this industry and then also in this company, QT Holdings. Yeah, then it could be that this is a winner. Well, the factor analysis, the quantitative analysis indicates that it's a strong buy, and that's mainly based on the strong growth. The stock is expected to achieve more profit growth next year. Look, the EBITDA growth is estimated at around 60%, and actually the EPS growth is even at 100%, so that's pretty bizarre. We also see here that the estimate is only 30%. In this database model, it's higher. So the question is, who is actually right? Actually, a quantitative analysis should be carried out here, and preferably by people who really have a stake in it. To be honest, my expertise isn't in finance, so this is a no-go for me. But for you, it might be interesting enough to look into research, and that's why we also publish this as an idea, for your awareness to look into further. The profitability seems poor, but that's really just because the company is in a growth phase. And indeed, there can be a very strong growth in the short term, and if it rises faster than expected, then the price will also increase further. SexRank indicates this as well. And if it rises faster than expected, then the price will also increase further. SexRank indicates to hold, the value gets an F, which makes sense. We can see that here. The valuation doesn't look good in the short term, at least. The demand drives everything in the long term. A very small piece, if you believe in this bit of technical analysis, then we see here that the MACD is starting to cross. That's not positive. The suggestion is also starting to decline. The price is starting to approach 1.20. To approach it, if you break through it, it might go down harder. And the valuation also seems high in the short term, probably a bit too high. The question is, of course, what the long-term growth potential is. So it could be really interesting to see what happens if the stock drops a bit further. So let's just assume for fun that it drops to this level roughly. Here could be a possible support level for the more short-term traders. Whoever dares to take that on, don't spend it on me. But this could still imply a price drop of about 25%. That's not exaggerated for a kind of good stock in this situation with the high valuation. So that could be a really nice price drop of about halfway. Then the valuation might seem more attractive again for 2025 or for the long term. A lower quality stock for 2025 is SkyWest. I might not buy this stock for the long term. However, it could be promising in 2025. But there are definitely some more uncertainties here. I didn't see any flying stars from Morningstar. I don't know exactly why, because the price target is lower than the current one. But SkyWest definitely has potential because it's growing very quickly. So it can be very interesting and it could really surprise in 2025. The analyst's price target. However, there are only about 5 of them. It indicates on 14, the current price is around 11. Let's look at the analysis in terms of forecasting the price to earnings ratio for next year is around 15. Well, EPS has good expectations, so profit, good expectations are around 7 to 8%. That's not on the very low side, not on the high side either. And a PE of 15 seems realistic, so you could achieve a great return of around 10% for a 2-year time frame. So why might Skyfest be interesting to look into for 2020? The business model is definitely interesting. By the way, it's for airlines, so it can be interesting. Have diversification in the portfolio. However, the factors that are labeled as strong buy and the valuation, growth, profitability are all very favorable at this moment, relatively speaking. So the price to earnings ratio for next year is estimated to be around 15. The failure rate is really very low. I don't think this is correct. The private cash flow is also on the low side. So that's really interesting, especially when you look at the free cash flow. That's, of course, important for the long-term investor. The growth rate is positive. For next year, a huge decline of 40% is still expected. And the EPS for the long term also seems very extreme. But Skybets does have some advantages and attractive factors that, at least statistically speaking, can lead to outperformance or alpha. Mutual equity, however, is not that high. Brands are healthy, but not great. In terms of the target, from 6 gifts, that's a goal. We actually give the same target of 111 as the current price. For SkyWest, there might be more opportunity if we have a bit of patience. Recently, it had dropped to around 100, possibly. If we're lucky, it could drop to 80 or, for example, to 72. And then it seems to be an interesting buy. But the stock is off, as you can see, in a significant upward trend. Since the last buy signal, it has risen by more than 400%. So times 5. Still, there seems to be some upward potential for SkyWest. Of course, the best is already out after a very big rise. I don't want to say that 2025 can't be a good year for this stock. The company Bill Williams Quiet could be an interesting value stock for 2025 that might exceed expectations. The ticker is PPC, and I'll show you why. This could be a potentially promising stock. By the way, I don't have this stock in my own portfolio. Now, what's interesting is that it scores very high on factors again, but it's a cyclical stock, so it could also be a momentum play. And on the other hand, we see that, for example, Morningstar, which looks more at the long term. And of course, the intrinsic value tries to calculate, in other words, the intrinsic value for the long term. That indicates the fair value. According to them, it's 38, while the current price is 45. Other analysts believe that the current price target of around 46 is justified. We'll see. It's a somewhat riskier stock, but it could be a value idea. Why? Because it's cyclical. So if it materializes more or less in the long term, it seems to be looking good. In another video, we actually highlighted Carnival. But let's take a look at PPC, Pilgrim's Pride. And here, of course, the whole situation stands out. What is the long-term growth going to do? It has recently increased a lot in value, and the price to earnings ratio now seems very low. Actually, with cyclical stocks, you should mainly buy when the price to earnings ratio seems very high. After a significant drop, because they might be making temporary losses, the cycle goes up again. So, might be a wrong time to buy Pilgrim's Pride. But maybe it's an interesting idea to look into further for 2025. So the final conclusion and judgment, I'll leave that to you. This is purely and simply the inspiration for further research. If we look at the estimates for 2025, analysts expect a decline, but there aren't many of them at all. So yes, the question is, do they have a point? Yes or no? In any case, factor analysis still indicates a strong buy in the short term right now. For example, momentum is very strong, but also EPS revision according to this date model is positive. So people expect that the number will make more profit, at least in the short term. The luck ratio is very low. So this doesn't seem to add up. You see, the price to earnings ratio is low in the sector right now. Median, and there is something happening in this sector, but I'm really not an expert in it. But Pilgrim's Pride is, of course, active in chickens and pigs. In any case, for example, eggs from chickens, the price of eggs is starting to rise a lot. So that could be interesting. Also for this company, it's relatively a bit larger. The market cap is 10 billion and total debt is not on the low side, I would say. But they do have relatively some cash on hand. Growth seems a bit mixed, but still with the expectation, at least according to these analysts, that growth for next year is still realistic at 5%. If that's the case, then the valuation is certainly not low. And here the stock could possibly perform unexpectedly better, but it's a risk for the stock, cyclical stock, so it could very well go the wrong way. So I personally wouldn't invest in it, but maybe you know a lot more about it, and that's why the respiration takes longer. The tunnel equity is also very high right now. Zexrank, however, indicates that it's a strong buy, according to them. The quarantine target for the next 6 to 12 months is estimated at $48. If you look at the movement, you can at least expect a lot of volatility. A price drop of minus 50% is actually nothing for this stock. And what's interesting is that now, at this moment in the short term, the stock is also starting to decline. So purely based on technical analysis, we see that the MACD is starting to decline below. That's never really a positive signal. The Sugestics is also declining. The price level drops below 1, makes 20. So those are actually 3 signals for the very short term that aren't very positive for this stock. It's also very high. At least that might seem to be the case, but there can be long-term growth. You only see the frequent cyclical declines. A drop of at least 50% feels like nothing, and it happens at least 1, 2, 3, 5 times. So maybe this is the 6th time. Well, then it will at least drop to about here. So then it could find a nice new support level at previous prices around 36. But that's all just basic technical analysis, and personally, I don't believe in it. So always look at the fundamental analysis, but also know that volatility can be profited from. At Happy Investors and Business Investors International, we actually share value stocks on a monthly basis, but also growth stocks and dividend stocks. You can gain access to those happy value stocks monthly value stocks, ideas, but also monthly top value stocks. Or are you actually already trying them? 3, value, growth, and dividend stocks. Or internationally the same offerings, but then in English through Business Investors, or in Dutch, Happy Investors. One of the stocks of 2022 was Call Name, the same sector, the same industry, and we had recommended that 2022 after a decline. Yes, about 20%. Since then, for a while, the stock had risen, then it dropped again. Look, but even a drop of about 5%, maybe just a little more. I don't know the exact date. More, and actually now, about 3 years later, the stock is still quite a bit higher. The same can happen at PPC. There could possibly be a further decline. To what price level it exactly drops, no idea. You can see that long term, the circular growth is, that's about it. Only the question is more about the short term. What happens? So this stock is really interesting for further investigation, and especially if they can resume growth, then the current valuation does seem to be cheap. But watch out for the cyclical decline. I'm really curious to know what you think about it. Or do you have more knowledge about this company? Then let me know in the comments and help others, including myself, also more knowledge about this company.